The saying, sell in May, go away and come back again on St. Ledger Day is one of the oldest of all market rules of thumb. And in this edition of our regular markets review, Breaking the Mould, I'm going to look at whether this rule has stood the test of time or not. Hello, I'm Russ Mould, AJ Bell's Investment Director, and after a choppy first 4 months of the year, investors will now be wondering whether to shut up shop for the summer by selling in May and then coming back in the autumn, as per the old rule. Now this year, the St. Ledger, the world's oldest classic horse race, will be run at its usual venue, Doncaster's Town Moor racetrack, on Saturday the 10th of September. We've therefore studied the FTSE All-Share from 1965 onwards to test out the market saying by looking at the performance of the index in 3 distinct time periods: 1 January to 30 April, 1 May to 10 September, 11 September to 31 December for each of the last 51 years. Conclusion: does sell in May, go away, come back on St. Ledger Day really work? Well, the answer is yes and no, and I say that for 2 reasons. The answer is yes, because the 1 January to 30 April period has, on average, and I stress on average, been the most rewarding for investors, while 1 May to 10 September has been the most challenging, on average. This first chart shows the average capital return from the All-Share since 1965 across those 3 periods. The second simply shows how many times the market went up out of 51 across that time span. Again, the first 4 months of the year do best, the middle 4 the worst. But the answer is no, because in 51 years the markets followed the pattern prescribed by sell in May of rising in the first 4 months, then falling, then running again. It's done that on just 14 times out of 51. So the adage doesn't work each and every year, even if the long run averages work out okay. Investors who sold in May would have missed out on double-digit percentage rallies no fewer than 10 times, most recently in 2009. There is one final trend which also emerges from the data. If the first 4 months of the year prove fallow, watch out, as the rest of the year tends to be difficult too. Between 1965 and 2015, the FTSE All-Share fell just 14 times in the first 4 months of the year, and on 10 occasions developed a loss for the full year overall, with an average downdraft of 10.8%. Now, we all know the past is no guarantee for the future, but with the FTSE All-Share flat to down a fraction as I sit here just before the 1st of May, this may be something to bear in mind. But in the end, buying in January, selling in May and buying again in September, it's only worked out just over a quarter of the time since 1965. So this suggests investors should think very carefully before they try to time the market. There's no guarantee the old pattern will work each year, plus such trading involves paying stamp duty, traders' spreads, brokers' commissions, as well as potentially tax. So frictional dealing costs would start to rack up pretty quickly, eating into portfolio returns. There's also the danger you could miss out on valuable dividend payments if you're trading in and out of the market. And it's been the harvesting and reinvestment of those dividends that's been the secret to making the most out of equities over the very long term, at least according to the FTSE All-Share's total history since its inception in April 1962. So thank you for watching, and I look forward to seeing you next time.